Greetings, members, one and all of the Salivation Nation. I have a very special guest with us as we discuss the inside scoop of the flash crash of gold and silver. With me here is Lior Gantz, who owns wealthresearchgroup.com. He is diversified in mining stocks, precious metals, real estate, and a large traditional stock market portfolio. Really knowledgeable person. I've seen several interviews with him on other channels, so we are very fortunate to have him here, an honor and privilege. Welcome, Lior Gantz.
Thank you for having me.
Well, Mr. Gantz, we saw a recent flash crash of gold and silver very recently here. There was we can see this as a massive buying opportunity, but you have some information about this flash crash. Can you tell us a little bit about this and what you know about this and what happened during this flash crash?
Absolutely. From my end, when looking at these kinds of big smashes to the price of gold in mere minutes, right? These are not prolonged or lengthy or anything. These are happening instantly upon news. So what sort of news creates these types of sell-offs for gold? Usually, the most bearish announcements for gold are very good job reports, because very good job reports indicate that the central banks might start tapering or tightening very soon. And with this one in particular, what the Federal Reserve already said, the Jerome Powell already said, is that if the jobs report in July and then right after in August, if both of them come out and are over 900,000 new jobs added, then in September, there is no question they will start tapering. Tapering means that they will buy less than $120 billion of assets every single month. So they buy 80 billion in treasuries and 40 billion in mortgage-backed securities. They will start taking this down. But even more importantly, they've said in the past that once they start tapering, 18 months later, you can expect them to start raising rates. And so this whole chain reaction is obviously discounting the price of gold, because when you have higher rates, then you have an environment with less of a probability for negative interest rates. And gold flourishes in an environment of negative rates, and it becomes less relevant in an environment with positive rates. The jobs report came in on Friday at 943,000. That's huge, well above the estimates from Bloomberg and from Wall Street. And the markets assumed that if this is so hot in July, it will probably be hot in August, meaning that they will start tapering. So what you see is you see all these algorithms selling, because they're programmed literally to sell if the jobs report is over 900,000 jobs. So that's instant. That's why it's so quick. And because it's on the COMEX, and if you go to our, for example, to our website, wealthresearchgroup.com/COMEX, I created a really cool special report about this whole situation that you can download to understand how these flash crashes happen behind the scenes over JP Morgan and Barclays and all these bullion banks, and how they create these spoof orders to get the markets to come down so fast and so predictably. So that's the first wave of sellers, the algorithms that are programmed to sell on announcement. But then you have a second layer of algorithms that simply get an order to sell if gold falls to a particular spot. It's sort of a stop-loss strategy for a lot of algorithms. And what happened was, the initial one was so bad that it triggered the second one. It triggered another layer of all these stop losses when it hit 1750. And so gold fell all the way below 1700, all the way to 1600s, and then it found support. So Monday morning, after this got really bad and didn't let up, we issued an alert, for example, on our newsletter, and we said, look, if you understand that the Fed will probably not taper in September because the jobs report in July was hot, but now because of the resurgence and mandates and whatnot, we expect August to actually slow down, then this is the buying opportunity. Now, if you think August will come in hot, then I would wait. And the reason I say that is because, and maybe that's a longer answer than you're asking, but the Fed since I don't know if you know this, but we're doing this interview on a very historic day. This is exactly 50 years from Nixon's announcement. So
that's right.
Yeah. So the amazing thing is the Fed has tightened or raised interest rates in the past 50 years on 6 different occasions. It started a rate hike campaign where it starts to tighten until it thinks that it has reached equilibrium. One was in 1972, so right after Nixon took us off the gold standard. Another one was in 1976. Then you had one in 1993, 1999 with the dot-com bubble. Another one in 2004 when real estate got really hot. And then the last one between 2015 and 2018. Do you know that the day that the Fed starts raising rates is actually the bottom for gold? And so what's interesting is gold is right now in its least favorite spot on its curve because it already hit an all-time high a year ago, like August 6, 2020. And then the market started to discount the price of gold because they said, look, this is like a Formula One car that's driving like 300 and the curve is right around the corner. They'll need to break this thing because inflation was getting high, everything. So the markets was forward-looking and started to discount gold. Gold went down from 2,069 an ounce at the record high to below 1,700 and tested that area twice. And now we're all anticipating the rate hike. So any news is bad news because you're anticipating the hike. So people are selling. Once the first hike happens, or once the Fed starts to announce that it's going to do a hike, then the markets are forward-looking. And what's the next step after hikes? It's the end of hikes. It's when they say, look, the market has reached this spot where if we raise rates again, we're going to crash the markets. And so gold will start to inflate again because that will be the next step for the Fed. You saw that perfectly in 2018 and 2019. So 2018 September was the low for gold. It was around 1,200. I don't know if you remember. There was a real bad flash crash for gold from like March to September of 2018. I actually picked up some physical at 1,200 in September. It was really bad. It even got to like 1180 intraday. And then 3 months later, the Fed said we're stopping this autopilot rate hikes, and they call it the monetary U-turn. And then April 1st, 2019 is when the BIS, the Bank of International Settlements, said, look, Basel III is happening. And if you look at a chart of gold, on that day, April 1st, 2019, gold was $1,291 an ounce. And so on that day, I literally said, look, if this is the price of gold today, the day they announced that they want to make it a tier 1 asset again, then basically what they're telling us is it's worth double that, right? Because if it turns from a tier 3 to a tier 1, now it's 100% in reserve and marked to market, right? Marked to 100% of its value, then it's worth 1,291 times 2, which is $2,582 an ounce. And so my mind is that's the real price of gold. And that's before they added $10 trillion to the economy in 2020. So, I'm very bullish on gold. And I think that the market is kind of getting it wrong on the hikes. I don't think that the Fed will taper. Now, if I'm wrong, then we'll see the price of gold continuing to go down, and probably will go down towards the 1500s before it bottoms. But if I'm right and the Fed surprises the market on September and said, look, the economy isn't strong enough to start tapering, then gold has a really good chance of going up towards the 2000s again.
That's great. And I remember when gold was low, and I bought at that time too in the $1,200 range as well. And you think about it, gold's resistance is something to behold that we're seeing when its bottom is in the high 1600 range. So it just goes to show you that gold holds fast. And I think a lot of it is because of what you mentioned about the Federal Reserve and all of this spending, the $10 trillion. We have two quote infrastructure packages now that Congress is dealing with. One is an actual infrastructure, then we have human infrastructure, one 1.2 trillion, the other one 3 point some odd trillion dollars. It's insanity. But talking about Basel III, and what happened, we did reach an important date where more of this information was coming through, and because Basel III is phased in. And we saw it happen, I think, on June 24th. Now nothing occurred. It was a big, like was the nothing burger. So what are your feelings about that? I kind of predicted that would happen, that not much would occur after that. But what are your thoughts on Basel III and where we go from here?
Yeah. So Basel III is not a nothing burger, but because it was known to the markets many months in advance, it was priced in.
That's what I thought too. Yeah.
When you see, do you remember Sharia a few years ago when the Muslims allowed gold to be purchased again? That was a big deal. It's basically a law that now allows Muslims in the Middle East and elsewhere to buy gold after it was illegal to do that in the past. So, to those of us that have been in precious metals for like 10 years, 12 years, we've seen a lot of these catalysts that build up for months and months, and they're priced in. Because they're building up for months and months, people are making decisions today knowing that it will happen on June 28th, for example. And so it's not that it's a nothing burger, it's part of why gold is where it is. Going forward, though, it will have implications on the market because, look, big changes have occurred in the past year and a half, not just in gold. Gold, the price of gold, is a derivative of everything else that you see in the world. People choose to purchase gold as a default. For example, governments and central banks buy gold whenever they feel like its price is cheaper compared to other fiat currencies. People buy gold when they fear inflation, and governments and institutions buy gold instead of buying bonds. So when interest rates are super low, they go into gold. So these different entities buy gold for different reasons. And its attractiveness is a derivative of negative rates. When real rates are negative, in other words, the discount between how much a government bond yields, and how much the CPI numbers are, if that deduction is negative, then gold is in high demand. Right now, if you look at the 10-year bond for the United States government, it's about 1.35 as we're doing this interview, 1.35%. And the CPI number is much higher. So you are living in a world where you cannot make a real rate of return lending the United States government money. And I'm talking about the United States government. If you look at like other countries, it's worse. The 10-year bond for Germany, a big economy, for Japan, a big economy, for Australia and other countries in Europe, they're all negative going into it. The 1.35 that Washington pays is a bargain compared to other countries. And so you live in a world where gold is very relevant to the situation. And now, when you make it a tier one asset, then you're giving legitimacy to banks and central banks, bullion banks, governments, pension funds, and institutions to buy gold. Because now it's marked at 100% of its value, not 50%. So I think that it's really good, but it's not like these banks are going to, go into the market and make themselves noticed like a, like a target.
Right.
There's a big buyer out there. It's an accumulation phase that's going to happen in the next 2-3 years, and it is important because they're big buyers. But for you and I and the audience, I think there's other things that we need to think about when it comes to Basel. And if you go to our website, for example, to wealthresearchgroup.com/Basel, BASEL, like the city in Switzerland where the BIS is headquartered, the central bank of central banks, you can download a report about Basel III and its implications and how it came about. Because the real importance here is that it makes it difficult for the bullion banks on the COMEX to play with the futures markets and the derivative markets. And that's exciting news for the community, because I hate to see these flash crashes that scare people out of positions for no reasons. The gold and silver have been around for 5,000 years. Jamie Dimon's trading desk is not going to change what gold and silver mean to the human race, and no matter how they try to spoof the market with orders and whatnot. So at the end of the day, to me, gold is a no-risk asset. I don't see the downside of owning gold under our fiat monetary system. To me, over the long term, if you look at the past 50 years, gold has accumulated at 6.6% return year over year on average. So if you own gold from 1971 until today, you've made 60 times your money. I mean, that's pretty remarkable, right? Or 50 times your money as we're doing this interview. So I think it's really important to keep in mind that the long term, if you are a stacker of physical, and then you're going to leave it to your kids or whatever, if you never sell, if your attitude is to accumulate the physical, what's the risk under the fiat monetary system? It's engineered to elevate the price of gold over time.
Well said. And you're echoing sentiments that I talk about. That's a foundation of what my channel is about. I always tell people that no matter what the price does, the fundamentals of gold and silver are strong. I want to shift a bit here because we talked about gold a lot in this interview, but there was also a flash crash of silver as well. Mm-hmm. And considering where we are at with inflation, and we know that a lot of times, it's not in lockstep, and with inflation goes up does not necessarily mean that silver and gold are just going to go skyrocket along with inflation. But why is silver not able to rally even under a short squeeze? And just as a little background, as I did watch the supposed short squeeze movement, and it did have a negligible effect on the spot price for a very short amount of time, but essentially didn't seem to do a whole lot. So I know silver stackers specifically are frustrated, especially when we have a silver to gold ratio now at above 75 again to 1.
Yeah. If you watched my interviews from January and February, then you know that I authored a report called wealthresearchgroup.com/squeeze. It's a special, it's a download report, and when people read it, I literally said, do not fall into this trap. You cannot squeeze silver. It's impossible with all the regulations today of the COMEX to squeeze silver, and it went through and explained it in detail. When the Hunt brothers in the 70s squeezed silver, they bought a third of the global supply of physical silver. Let me repeat that. A third was owned by two people. And so the government intervened and told them to unwind their position. That's how it came to a close. And they had to force liquidate their position. And that got the baby boomers, all the baby boomers remember is that squeeze and that move from $1.92 in 1971 when when the Nixon shock happened to 50. It's an insane move in 10 years, 25 times your money. Okay, so why can't this happen today? This short position that everybody keeps talking about with silver, it's not like with GME or with AMC where it was a naked short, where more than 100% of the supply was shorted. No, the silver short is way smaller. It's just very concentrated. There's like 8 big short positions. So that's the unique part about the silver short position, that it's very concentrated. But if you're looking at the COMEX, it's not just silver that trades in many multiples of how much there is in existence. All commodities except for cocoa beans and I believe copper trade at many multiples of their real existence. So in other words, if the future markets did not exist, then many people would lose their money because they're betting on supply that isn't there. And the reason that this market is allowed to happen, the future markets and the derivatives market, is because companies and especially governments like the Chinese government need to source supply 5 years ahead, and they need to lock some sort of a price that's more fixed. And if they don't use the futures market to hedge their position, then other players will choke the supply, and the Chinese government, which is building a city, will have to pay $100 for every ounce of silver, or $200 or whatever, because you can play with the supply if there is no futures market. So the future market is there not so JP Morgan can make trading profits, but they abuse the market in order to do that. But that's not its function, right? You know what I mean? It's like electricity doesn't exist in my house so I can stick my finger in the socket and get electrocuted. It can happen if I abuse the power of the socket, right? So that's what's happening in the COMEX. There's just abuse of the system, but the overarching reason it exists is to help moderate and hedge prices for big projects in silver and all the other commodities. Silver is very problematic to squeeze, but the beauty about it is that it creates two markets, and that's my big lesson to traders that are listening to this. Go back to March of 2020. If you want to buy a physical ounce of silver, you pay 40, 45, right?
Yep.
Okay, but on the COMEX, you pay $12. And so this rigged market creates a huge arbitrage where you know that what you can do in the short term is load up on the paper, right, using either the SLV or the PSLV or whatever, silver options, the miners, etc. You go into one of these paper instruments, you make a fortune in 2-3 weeks while the market comes back to becoming like one market where the physical premium and the paper discount basically find their new equilibrium, and then you take the profits and you buy physical without paying 50% premiums. So I like to take advantage of the fact that there's two markets at extreme situations, not to be taking advantage of. I don't like to pay the high premiums. I like to pay the big discounts, and then once the premiums are gone, go back to accumulating more physical. So that's how I like to play both market. You know what I mean? Both sides of this, because if they're going to manipulate the price down, I need to take advantage of that. But they obviously can't manipulate physical silver, so I just need to wait until if there's a big demand. I wait until it dies down, because my strategy is to stack, right? I want to
Right.
stack, so I want to pay the lowest price possible for my stack. But if I'm trading, I want to pay low and sell higher.
So that's an excellent way to be able to put your money into physical by using both those markets. So let's talk about what is the most proven and profitable strategy for accumulating and investing in precious metals in mining stocks.
Okay. Um, so the mining stocks world is very risky because when you hear the term a mining stock, you think that the company has assets that are either gold assets, silver assets, etc. There are about 1,800 gold, silver, copper, etc., zinc mining companies trading on the stock markets in North America. But very few of them actually own assets that are either operating mines, so they actually do the work, refine it, put it in the crusher, sell it, make a profit. They operate a mine, or they're developing a project that will become a mine. Very few. The rest of the companies are either drilling and have found something, but it may or may not be something that's economical. That it may not even become a mine ever. Okay, and there are other companies, most other companies, that have nothing. They bought land, they believe there's some gold there or silver or whatever, and they need to still prove it. And so when you look at mining stocks, you need to really understand which ones you want to be involved with and own a piece of. Because when you buy shares of a company and become a shareholder, you're a part owner of a business. And you need to know the first thing about the business that you're buying is what are its assets, what are the income column, the expense column, who's running my business, right? Who are the people? What's the financial position? Where are my assets located at, etc. All these questions. So the first thing I would do when looking at a mining company is I would first of all look at what type of mining company it is. And if you go to our website to I know I keep saying that, but if you actually go to wealthresearchgroup.com/gold playbook, it's a whole comprehensive manual about all the different types of mining companies in the world. The most proven strategy within the mining world is called the royalty business. The royalty business is a company that creates a situation where, like a songwriter or like a band that releases a song, they get a royalty every time the song gets played. And so they don't need to risk the money creating a music television channel or a radio station or whatever. They create the song and they license the rights to all of these other business people that will try to figure out where the public would like to hear the song. But they will make money on the song all the time. And that's what the royalty companies do. They go to other companies that either run mines or develop mines, and they tell them, look, we'll loan you money to build this project. Once it's up and running, we want to make part of the gains. But we're not going to drill. We're not going to explore. We're not going to develop. We're not doing anything. We're loaning you money. And so if you default on this, we take over this project from you. And that is a very profitable business model. If you look at the best royalty companies, they have outperformed the S&P 500, the NASDAQ, the Dow over time. There are three major ones, big ones. If you free search it on Google, you'll see exactly which ones I mean. And then there are smaller ones that want to become the big ones. And now there are royalty companies that are not in gold and silver, but are looking to be royalty companies in other ventures because they saw how profitable it is. So now they're going into base metals, energy sources, agriculture commodities. It's becoming a real important industry. So that's the first thing I would look at. If you're looking at a mining company, I would look at the royalty sector first because it's proven itself to be extremely durable to recessions and to the fluctuations of the price of gold and silver. Then, if you're looking at the other side, the side that are either exploring, developing, or mining, um, to me, I always call the companies. I always call them. I always want to speak with management to ask my questions, and understand more about the business, because these are very risky businesses, and the best ones succeed because of the management team. Think about it. At the end of the day, what are they selling? All mining companies sell the same thing, right? They sell either gold, silver, whatever they're selling. It's not different. It's not like a restaurant where your pasta can be better than my pasta because your sauce is better than mine. There's no difference. They're all selling the same product. And so when everyone's selling the same product and they're not controlling the price is dictated. The management teams is important because they create the cost factor. Because if your mine is $800 an ounce to mine the gold, and mine is $900, and this guy's is $1,000, and this guy's is $600, well, the one that mines the cheapest and with the highest grade makes more money. And so what you're looking for is which management team knows how to build these types of companies in the best way. So management is really important to me. And then I also want to know how much management owns of the project. I want to know that the people actually running this company, which I want to own part of, are in the same boat as I am. I want to know that they're risking millions of dollars. And when they wake up in the morning and look at their kids, their kids' destiny or inheritance or whatever you want to call it is also dependent on success, that they're not making huge salaries, and if they get laid off tomorrow, then whatever, you know what I mean? They move on to another company. I want to know that their incentives is the stock price and not a big fat salary. I want to know that they're incentivized by having skin in the game. And the other part is I want to know that they've done it before. I only like to invest in mining companies where the top people, this is not their first rodeo. You know what I mean? I want to know that they've been around and have done this before. I want to know that they know how to take it from A to Z. Because otherwise you're speculating, right? You're speculating if this person will do it for the first time or not. So that's another thing. And then lastly, I want to know where this property is. I want to know that it's in an area where one day it can become a mine. And how do I know that? Or how do I de-risk that? Well, first, if there's infrastructure, if there's a power line, if there are roads, if the weather is good, because some of them are, you know, up in the snow and you can't mine for half of the year or can't drill. I want to know that it's in an environment where the actual communities around the mine want the mine to be there and won't do strikes and other problems. I want to know that the government is stable in that area as well. And so all these things come together when it comes to the asset. And then lastly, what you really want to know is whether or not the current price is attractive. Some companies are phenomenal companies, but they're also priced at phenomenal prices. And what I want is that gap between how good of a company it is and where the market is pricing it at. That's where there's that margin of safety, that arbitrage that you're buying low. You don't need to buy at liquidation prices. This is, it's not the Great Depression, right? We're not buying companies like Warren Buffett bought them 70 years ago when they were all cheap. We're buying companies in a very good economy. The global economy is in good shape, and there are very few bankruptcies, compared to 70, 80 years ago. And so it's not about buying it at liquidation prices. It's just making sure that you're buying it after big corrections. I like that, right? I like to buy after like good dips, 20 to 30 to 40%, just on people taking profits, not because something happened with the company. Just shareholders that are taking profits because they've made a nice gain, and now other shareholders will, replace them. So those are sort of my guidelines, and obviously the report at Slash Gold Playbook goes into this in further detail.
Excellent, excellent advice. And thank you so much, Lior. And to cap up this interview, again, if you want to check out the inside scoop about what happened during that flash crash, go over to wealthresearchgroup.com/COMEX, correct?
Yes, sir.
Very good. Well, thank you, Lior. This has been wonderful, a great interaction here. And I want to thank you so much for your time here. And I want to extend a multitude of gratitude to all of you for taking the time to watch this interview. Post your thoughts in the comment section below. And I would like to extend the multitude of gratitude and encourage you to please rate, share, comment, and subscribe.